What's going on, investors, and welcome back to my channel. In this video we're going to focus on blue chip stocks, what they are and why it's important to consider having them in your portfolio. But before we start, of course, we need to remember that nothing in this video is financial advice and I'm not a financial advisor. But without further ado, let's jump straight into it. So in short, blue chip stocks are financially sound, well established and recognized companies. They're generally large cap and they're financially stable. So this means that even in adverse economic climates, they generally perform quite well. Just stop and have a think about any household products that you may have. For example, your toothpaste or the body oil that you use, or even the drinks that you drink. You'll tend to find that they are generally from the same couple of companies. For example, many drinks are owned by Coca-Cola or Pepsi. Many cosmetics and household products are owned by PG, Procter & Gamble, or GSK, GlaxoSmithKline. These are well-known, well-established companies. So because of this, even in difficult economic times like recessions or such as the pandemic, their sales don't tend to go down. They actually tend to go up. Sometimes these are known as defensive stocks as opposed to cyclical stocks like cars. Only when the economy is good, people are buying cars or going on holidays or buying fancy clothes generally. But when the economy is bad, regardless, you still need to eat, you still need to look after your health. So these are consumer defensive stocks, 24/7, 365 or 366 days of the year. These companies are generating sales and revenues. Now you might be wondering, why exactly do people invest in blue chip stocks? They're old established companies and they don't really have large growth. They tend to grow at a small rate. Let's just say Pepsi, for example. It grows at a much slower rate than Tesla or Neo. So why is it worth even considering investing in these stocks? There are a lot of answers for this question. For example, if you're a value investor, you want to buy low, sell high, and you don't necessarily expect to have 20-30% a year returns, because realistically 6 to 7% is more average, and 6 to 7% yearly consistently is better than making 30-40% every now and then making 1 or 2% or even losing in other years, right? But perhaps one of the main reasons for considering investing in value stocks is simply because consumers have dual spending habits. This means that for some products and services, we want bang for our buck. We want to save our money. We want things cheap. But for other services, we don't mind spending extra for perceived quality, for perceived better products, for perceived brand names. Let's say you had family over for an event, for example. Generally, at least in Asian households anyway, you will see Coca-Cola, but on a normal day they might drink Lidl or Aldi Pop, who knows. But why did we spend a bit more and get Coca-Cola for a family event? The simple answer is because it's perceived to be better quality. For all you know, the taste might be the same. Me personally, I prefer Pepsi over Coke, but I know that Coca-Cola is seen as a more pristine company, and for this reason we often don't mind spending more on it. And because of this, these brands are perceived as strong and more trustworthy, and this gives them a strong competitive advantage over rivals and allows them to generate revenue and profit. Now this strong competitive advantage is often known as a moat. This company has a moat. People like Warren Buffett, they refer to it as a castle. But what exactly is a moat? A building might have water around it, making it difficult to conquer that building. That water is called a moat. So blue chip companies, strong, well-established household name companies, generally have moats. This means it's difficult for the new kid on the block just to take all of their business in one day. New beverage companies come and go all the time, but Coca-Cola still appears to be on top. How likely is it that a new company will come and take Coca-Cola from the top spot? It's not impossible, but it's difficult. This is because Coca-Cola has a moat, a strong competitive advantage over its rivals. Now this moat is something that we tend to only really see in blue chip stocks. And that's why many investors like to invest in blue chip stocks, because realistically they make money all year round and they're probably going to be around for a long time. In order to have become a blue chip stock in the first place, they are well-established business, they have good business models, and they are generally quite profitable. Many of them are even dividend aristocrats and dividend kings. And that's it for this short stock market education video. I hope by watching it you've gained a better understanding of what a blue chip stock is and why investors like investing in them. I hope this video has been valuable to you, and if you have benefited from it, please consider hitting that like button and subscribing to my channel and checking out my other videos on stock market education. But that's it from me. Take care, and I'll see you on the other side. Peace.